Hello, I'm Emily.
I'm George. In this video, we'll break down stock markets and how they work.
Let's start by talking about shares. A company may decide to list its shares on an exchange, making them available to the public in order to raise capital. Each listed share represents a portion of ownership in the company. Shares are initially listed at a specific price, but once they're listed, prices can change. There are many factors that can affect the share price, as well as the behavior of the entire stock market.
The stock market is a broad term used to describe a collection of stocks traded on exchanges around the world. In practice, when people talk about the stock market, they're often referring to the performance of a specific part of the stock market, which is often represented by an index.
A stock market index is a collection of stocks that are related to one another. The index aims to track a specific part of the market.
Some common indexes are the S&P/TSX Composite in Canada and the S&P 500 index in the US. These indexes are collections of the largest companies on stock exchanges in their respective countries.
You can see how, instead of looking at one individual company, by using an index, we can see the general performance of a market. Stock markets, or indexes, rise and fall due to the behavior of the stocks and their prices within them.
The price a stock is sold for is the price that buyers and sellers agree upon based on what's going on in the market.
This is the intersection of supply, how many shares of the stock are available in the market, and demand, how many prospective buyers there are.
The number of shares available in the market typically only changes if companies make more shares available for purchase or buy back their own shares in the market.
Let's talk more about demand. There are many factors that can affect the demand for a specific stock.
When a company has shares that are listed, it is widely followed by investors. The company must make certain information accessible to the public. This includes company financial statements, news about mergers and acquisitions, or changes to the management team. All of this information can influence the price investors are willing to pay for a stock.
For example, if a company releases information that shows strong profitability, this may increase the share price because investors expect the company will pay dividends to shareholders or be even more profitable in the future.
News and data in the world can affect a larger group of stocks every day as the sentiment around a stock market changes. Put another way, stock prices can change based on how positively or negatively investors see the market that they're in.
Take COVID-19 as an example. When the news came out that most workers would be forced to work from home, stocks in the video conferencing technology business reacted positively because more people would need to use their software and earnings increased. Meanwhile, stocks in the service industry like restaurants or malls reacted negatively because fewer people ate out or went shopping in person, and earnings fell.
You can think about stock markets as forward-looking because investors are constantly trying to account for future events based on the information available. There's a theory called the efficient market hypothesis. This theory states that the current price of a stock reflects all the existing information available. In other words, stock prices and total company value always reflect fair value.
However, this theory is widely debated because it is difficult for all stock prices to perfectly incorporate all available information all the time. And if it were true, investors would not be able to earn returns on their investments that are higher than a stock index that tracks the market. Since stock prices are always fairly valued, then the stock market is too.
Market indexes are often used as benchmarks for investors to measure their returns against, allowing investors to see how their portfolio performs relative to a broader market. If the efficient market hypothesis is true, investors would be better off by simply investing in ETFs or mutual funds that track an index.
This is based on the belief that markets digest new information immediately, so share prices are updated immediately. Thus, there is no way an investor can outperform a benchmark.
Some investors, referred to as active managers, disagree that markets are completely efficient and believe they can beat the market through research and skill. Some have been able to do so over long periods of time, like Warren Buffett and Fidelity's Peter Lynch.
When building an investment portfolio, investors may select different types of investment products and strategies, depending on whether they believe the markets are perfectly efficient. And don't forget to consider that some markets may be more efficient than others, depending on how many eyeballs are watching them.
Let's wrap up. The stock market is a collection of company shares that have their prices determined by supply and demand. These prices change constantly as new information becomes available about companies or broader themes.
These markets are at least somewhat efficient since new information affects stock prices and market indexes.
The efficient market hypothesis states that stock prices always perfectly reflect new information, but if stock prices don't, you may be able to find mispricing opportunities through research that can help you earn higher returns than the market.
Thanks for joining us today. Make sure to continue following along with our videos to learn more about investing. Have a great day.